Hey everyone, welcome to Fundamentals Unfiltered. I'm Matt with the Fundamental Investing Institute. We are recording this on October 7th, 2025. I guess I should start today's video with an apology, maybe not an apology, at least an explanation. Because I think we've done 7 of these videos, and I would say the majority of them I have discussed, if not touched upon, 2 things. One is interest rates slash Federal Reserve drama. Second being private markets, and particularly private credits. And I should tell you why I'm doing that. Big part of what I'm doing in this show is I go throughout the week 6 or 7, sometimes more, but 6, 7 plus financial news outlets that I have subscriptions to. Sometimes I pull articles from different places through links or whatever. But I'm really looking for things that investors should be nervous about in terms of the macro picture, the macro being the broader economy. I'll talk about that a little bit later in the show because, I buy stocks. That's primarily what I do. I research companies, have some experience in real estate. This is something I've been, doing, but I'm a very, very much a bottom-up investor in terms of looking at individual industries and companies and individual investment assets. And a lot of people who do this really talk about just kind of ignoring the macro altogether. I'll talk about that later in the show, though, but I just wanted to say, unlike a lot of people, I want to highlight things that we should probably be a little bit nervous about. I'm not saying I think, things are going to crash, or I'm not saying that at all. It's just there are times to be a little nervous, and how do we deal with that? We pay prices that have a little bit higher margin of safety. Maybe we increase allocations to low risk assets, whatever. There's a lot of ways to sort of deal with it. But I'm the guy throwing cold water on the fire. So not surprisingly, today I want to talk a little bit about interest rates and private credits. Private credit markets. The government shutdown is interesting for a variety of different reasons, and it's sad and the whole thing. And I would remind all the viewers, all the listeners, the United States debt had been downgraded by the 3 major credit agencies. That's Standard & Poor's, Moody's, and Fitch. I think Standard & Poor's was the first to downgrade U.S. credit. This is back in the 2000s. Maybe within 2 years of the financial crisis or so, that the S&P downgraded United States debt from AAA credit. The reasoning wasn't so much the ballooning debt, which was understandable in the context of a very weak economy. The reason was that we didn't seem to have the political will to do anything about it. In other words, there was just a lot of political malfunction or dysfunction, if you want to call it that, with the 2 major political parties. And I think that's just been borne out over the last decade and a half, plus since that's happened. And of course, at the time that we record this, we're still have an ongoing government shutdown. One of the consequences of that I hadn't really even thought of, the FOMC meets later in the month. And of course, one of the things they look at jobs data. Jobs data comes from the Bureau of Labor Statistics. And the BLS, with the government shutdown, is not producing those reports. So it's kind of a question of what the FOMC is going to use. Of course, they look at a lot of information, some of which they pull themselves. So there's an article in the Wall Street Journal about this. Actually, I will say, the Wall Street Journal, the Financial Times, a number of publications brought this up. the FOMC, but also private, private institutions, traders, excuse me, they are having to rely on private sector or so-called private label jobs data. So, for example, ADP, which is a payroll company, they produce a jobs report. There are a number of others, but they're kind of being increased in importance, not only because of the shutdown. That's just unique to the last 2 weeks or so, but also the BLS is going through a lot of dysfunction. Some of it, the president fired the head of the BLS. He then pulled the nomination. I'm glad he did, but he pulled the nomination of the person who he wanted to be in charge. This was an economist at the Heritage Foundation. It was just far too partisan a pick. So hopefully we get someone more qualified in there. But the BLS has had a lot of issues. One of them is the surveys that the Bureau of Labor Statistics relies upon to pull together this information. This is why they've had such big revisions. So they're having a really hard time getting private companies, to participate in these surveys. So I don't know. We probably need a big restructuring of the BLS, modernization. I don't know. Make sure these statistics are better. But the point is, when the FOMC meets, they meet later in this month. They're not going to have the information that they normally would. So we'll see. One thing that I'm looking forward to, I think maybe next week, the minutes of last month's FOMC meeting comes out. I like to read through them. I read through the minutes as opposed to the transcripts. The minutes, of course, are more of a summary, but as we know, Stephen Myron voted for a half a point cut. Everyone else voted for a 25 basis point or a quarter of a point cut, and be interesting to see what those meetings say. Any event, onto the private credit markets. I can't leave this issue alone because, frankly, every week there's just more and more articles coming out voicing concern about private credit. And of course, what happened after the financial crisis is banks pulled back for regulatory and other reasons. They pulled back on lending, especially to smaller companies, lower middle market companies, and so you had this industry that arose, private equity really, that arose to do this lending, and it was they broadcast very attractive returns. It's essentially equity-like returns, double-digit yields with less risk than equity, because debt is, generally less risky than equity because it's contractually protected. So this market, I think it's approaching $2 trillion now. It was virtually nothing, a little over a decade ago. But you had two bankruptcies recently, both in the auto sector. One was a subprime lender, a company that does auto loans for lower credit score customers. The other company was an auto parts company. In both cases, there's some accusations of fraud or at least accounting improprieties. But there are a lot of people getting nervous that there are going to be more defaults coming. Default rates in private credits have been rising. So Barron's had an article titled "Public Bonds Are Booming. Why is Private Credit Flashing Distress?" And what they're doing is they're looking at what's happening with publicly traded bonds, traditional bonds. And remember, I think I touched upon this in our last video. The way that we look at risk in bonds is we look at the interest rate on the bond versus, we're talking about corporate bonds here. We look at the interest rate on the corporate bonds versus the interest rate on U.S. Treasuries, because U.S. Treasuries are still considered theoretically risk-free. So that's the risk premium. The risk premium on investment-grade corporate bonds is at near historic lows, if not historic lows. The risk premium on so-called junk bonds, which are the higher risk corporate credits, those are at or near historic lows. So that market's booming. In private credit, you have a lot of distress coming from these two big bankruptcies, but one of the big issues that I've touched on are payment in kind, where more of your interest yield is coming in the form of the issuance of additional debt as opposed to cash payment, which I think you could look at as a form of partial default. And the reason I bring this up is because this is an area that is going to be more and more open to retail investors. There was an executive order back in August that's going to allow private equity funds to tap into 401k money. And, cynically, I think it's simply a way to cash out institutional investors at the expense of retail investors. So I just caution everyone to tread very lightly, and hopefully you have a good financial advisor involved that can help you navigate those waters. We will do our best here to keep everyone abreast. But that's one article. The Economist had another article. Credit markets looking increasingly dangerous, kind of talking about the same thing. Defaults increasing, payment in kind becoming a larger and larger portion of the market, and just generally looking at this kind of skepticism. So that brings me to, there's an interview with Jim Chanos in the Financial Times. Jim Chanos is a short seller, and I know short sellers get a really bad rap. They're villainized, especially with a lot of the meme stock trading of a few years ago, and I guess it's coming back to an extent now. But I will say there's short sellers who focus on shorting stocks that they think are are overvalued. And of course, what shorting is you're borrowing stock from your broker, you're selling that, you're receiving the proceeds, you're hoping that the stock goes down. If it goes down, you can buy the stock back at a lower price, make the difference. It's a really kind of dangerous strategy. I've shorted some stock. I've never shorted directly. I always use put options. That's besides the point for our conversation, but the point I want to make is Jim Chanos focuses on, or is a specialist in what's called forensic financial analysis. So he essentially is very good at diving very deep into a company's finances and looking at fraud. And those kind of short sellers, in my opinion, are very, very important to keeping markets functioning and keeping markets at a higher level of integrity, because frankly they do a better job at it in many cases than the regulators. So Chanos, I think he really came to prominence with the Enron scandal, but he's an interesting voice here to weigh in on these two bankruptcies. Chanos, he also teaches a course at Yale. I think it's like the history of financial fraud, something like that. So he's very much an expert on this. But he gives this interview in the Financial Times, and it's very interesting because he does talk a lot about some parallels with some of what's going on with private credits and some of what was going on in the late 90s, early 2000s, just in terms of when times are good and there's a lot of optimism, investors tend to let their guard down, and credit underwriters tend to let their guard down. So you just have a much lower risk standard, and that's really where fraud comes up. So, Chanos is making the point that there is very seldom only one cockroach in the kitchen. So we may be seeing not only more defaults in private credits, but we may be seeing more potential fraud or accounting improprieties. And that's a big part of what's behind these two bankruptcies. So again, I bring this up because this is the world that is going to become increasingly more accessible to retail investors. This is not just institutional, this is not just endowments and insurance funds and others. This is going to be a bigger part of the retirement savings of American workers. So we need to understand the risks here. These private credit markets do seem to be going through some liquidity issues, and that's the case for private equity in general. So I'm really kind of skeptical, but we'll see. The president signed the executive order in August. Not much has come out. We'll see what that looks like. The other issue that I want to bring up today is AI, and not in specific terms of specific companies, but there was a great editorial in the Financial Times. It's written by Rashir Sharma. He's the head of Rockefeller Capital Management's international business. This is a big money management firm that kind of grew out of the Rockefeller family investment office. Smart guy, knows what's going on in global markets, but he wrote a really good editorial. It's called "America is Now One Big Bet on AI," and he talks about, I didn't know these numbers. I knew that they were high, but I hadn't done research on the numbers. But he gives some really staggering numbers. 40% of GDP growth in the U.S. is attributed to AI investments. 40%. 80% of U.S. stock gains are concentrated in AI companies, directly companies that are in AI, or they're really on the periphery of AI. 80%. And something I want to talk about probably in a later video is a little bit about index funds and how they're, or I shouldn't say index funds, different indices, stock indices that we follow and how they're constructed, because I don't think that the stock indices, the headline indices, are good barometers of the broader economy, and I'll talk about that in another video. But moving on, another statistic he gives in this article, and a point he makes is, with the surge in equities, and of course equities tend to follow, or the benefits of equities tend to flow to higher income earners. 10% of U.S. income earners, the top 10% of U.S. income earners, and these are the people who are primarily the beneficiaries of the AI boom. Maybe people watching this show, myself, I don't know, but the point is, this is accounting for a larger proportion of consumer spending. According to the author, it's half. Half of consumer spending is now coming from the top 10% of income earners. So the point that the author is making in this editorial is that the U.S. economy has some structural issues, particularly in our labor markets. Our labor markets are, smaller, regardless of what you think about immigration. It is having effects on U.S. labor markets. There are other things that are going on, and that is being kind of masked by everything that's going on with AI. Now, is this justified or is it not justified? Well, the promise is that AI is going to lead to a huge productivity boom. Productivity being output, per worker, per hour. But it's really kind of the blood of economic growth. So there's this, that's what everyone's kind of betting on, is this huge AI-driven productivity boom. And his point is, if that falls short, you're going to see some of these structural problems. They're being kind of hidden right now. So, again, just another smart guy who's worried about some things, and I'm bringing that up. The Economist had an article talking about this boom in AI data centers, AI expenditures in general. McKinsey estimates that AI investments will exceed $5 trillion over the next 5 years. They put out this number, over $5 trillion. and they're actually revising it. According to the article, they're actually revising this upwards. So you have these huge AI. You have these huge AI data centers. We're seeing more articles like this where there's a lot of people who are nervous about the capital expenditure cycle in AI. One thing I will say as an investor, I learned a long time ago, and it really pays to pay attention to the capital expenditure cycle in a given industry. When companies invest a lot in capacity, that really portends excess capacity in the industry, which is going to mean lower prices. It's going to mean lower margins. We don't know who the winners and losers are going to be on the AI front. One of the things the article brings up is it sort of ties back to credit markets, is that, when the companies behind the AI data centers, when we're talking about Amazon and Microsoft, obviously these are the highest credit quality companies sitting on lots of cash, but now we're starting to see smaller companies smaller startups that are behind a lot of these AI data center booms, and you don't know who's going to be around for 5 years. There's like any startup wave, there are going to be a lot of companies that go under. So you may see some fracturing in capital markets just on that. But again, these two articles just highlight how much the American economy is becoming more and more contingent on this one technology. Now, just to touch on what I mentioned before, which is, why do these macro factors matter? And I'm just going to say now, I'm going to address this in a subsequent video where I'm going to talk about different macro variables that investors can follow. But a lot of people, they'll go back to Warren Buffett. Buffett's talked a lot about, he doesn't factor the macro into his investment process. And I agree. I'm a very bottom-up, stock-by-stock investor. But I've also lived through the financial crisis. I lived through the pandemic. I've lived through some smaller bubbles. You ignore the macro at your peril. And one thing I will say about Buffett is he notoriously reads 5 newspapers a day. He knows what's going on in the world. There's a big difference between not making macroeconomic predictions and not paying attention to what's going on. I don't make macroeconomic predictions. I don't recommend that anyone else do them, but we should pay attention to some key risk variables. I learned the hard way. We should pay attention to what's going on in credit markets, especially because I think they're better. I think credit markets are the best barometer of broader economic risk. When credit markets break down, you are in trouble, whether you own stocks or real estate or just about anything else. And of course, it brings me back to another point that I should make. Gold prices still going up. I think as of yesterday, they were flirting with 4,000 an ounce. Crazy. Bitcoin's up quite a bit. Bitcoin's interesting. I can't say I know a lot about it. I've never bought it. I've been just a spectator in all this, but I'm curious to see what the correlations are if Bitcoin just sort of trades like gold as the dollar goes down. I don't really know. It seems to be not much correlated to anything right now. So to move on to what I'm reading, I mentioned this book last week. Hopefully you can see it on the camera. It's called The World's Worst Bet. It's by a journalist named David Lynch, who's been international economics correspondent for some big publications. I started this book last week. I got partially the way through it when we did the video. I'm about done. I'm down to the last chapter. It is a great book talking about really the embrace of globalization from the mid-90s onward, how a lot of things that the policymakers who are embracing this thought would happen didn't happen, who the winners and losers are. I think in his last chapter he actually gets into some policy recommendations, which may be the biggest contributing factor of the book. But I'm actually doing a very big deep dive on global economics right now, which is something that I know a little bit about, maybe from a textbook standpoint, but I'm doing a very deep dive into this. We're going to be creating some videos talking about the process and recording everything that we do. I'm actually launching a Substack this week, and that is going to talk about the process, about how I'm putting together my reading lists and all this, and the organization of that, and then just kind of documenting the process as we go. Hopefully it can be can show everybody how I put together my own self-study, and maybe people can go along. With that said, hope everyone has a great week. Best of luck in your investment endeavors, and as always, focus on the fundamentals.